The year is not 2025, but 1928, and the world is vibrating with a terminal kind of energy. On the surface, the machine of global prosperity has never looked more polished. The ticker tape is screaming the skylines are reaching for the clouds, and the consensus among the financial elite is that we have entered a permanent plateau of prosperity. But beneath the mahogany desks of the Federal Reserve and the marble floors of the Bank of England, a different story is being written in the ink of ledger books. It is a story of a world choked by invisible debt, a global trade system fractured by post-war ego, and a speculative fever that has detached completely from the physical reality of production. For decades, we have looked back at the Great Depression as a ghost story, a unique, localized tragedy caused by the primitive errors of a bygone era. We told ourselves that with our sophisticated algorithms, our central bank interventions, and our globalized safety nets, we had effectively killed the ghost. But history does not care for our arrogance. Patterns are not just coincidences. They are the mathematical echoes of human nature and systemic architecture, and right now, the frequency of those echoes is reaching a deafening crescendo. The danger we face today is not a recession in the traditional sense, but a structural synchronization of failures that the world has not witnessed in nearly a century. When we analyze the macroeconomic data through the lens of long-wave cycles, specifically the intersection of the debt supercycle and the geopolitical transition cycle, the similarities between the late 1920s and the current decade cease to be interesting and start to be terrifying. We are seeing the same concentration of wealth at the absolute peak of a speculative bubble, the same fragmentation of global trade into hostile blocks, and most importantly, the same desperate attempt by central banks to maintain a debt-based illusion that has run out of runway. This is the 1929 pattern, a rare and violent alignment of economic variables that occurs when a global hegemon loses control of its currency and the world as debtors can no longer find a way to pay for the future by borrowing from the present. To understand why this pattern has returned, we must first go back to the smoking ruins of the First World War, where the seeds of 1929 were actually planted. The world before 1914 was a masterpiece of global integration, underpinned by the British pound and the gold standard. But the war decimated the old order, leaving Europe buried in an impossible mountain of debt and reparations. The United States emerged as the world's new creditor, but the transition was clumsy. The 1920s were not just about jazz and flappers. They were a decade defined by a massive artificial expansion of credit, used to paper over the structural rot left by the war. As the Federal Reserve kept interest rates low to help the Bank of England maintain its prestige, they inadvertently fueled a domestic speculative mania. Money flowed into the stock market, not because companies were more productive, but because the cost of borrowing was lower than the rate of asset appreciation. It was a feedback loop that ignored the fact that the underlying global economy, the farmers, the manufacturers, and the middle class, was already beginning to drown in a deflationary spiral. By 1927, the internal pressures were becoming unbearable. The world was split between nations trying to defend their currencies and nations trying to expand their markets, leading to a series of protectionist skirmishes that would eventually become the Smoot-Hawley Tariff Act. Central banks were trapped in a paradox. If they raised rates to stop the speculation, they would crush the fragile global economy. If they kept rates low, the bubble would grow until its eventual burst destroyed everything. They chose to wait, hoping for a soft landing that history never provides. This period was characterized by a specific technical phenomenon known as divergence, where the financial markets continue to hit record highs, while the real-world indicators, commodity prices, freight rates, and industrial orders, begin to roll over. It is exactly here, in this gap between the chart and the reality, where the 1929 pattern hides. It is the moment when the system becomes brittle, meaning it no longer requires a massive catastrophe to collapse. It only requires a single, relatively small spark to reveal that there is no liquidity left to catch the fall. As we pivot to the narrative deep dive, we see that the architecture of our modern world was built on the very lessons we claim to have learned from that collapse, yet we have paradoxically recreated the exact same vulnerabilities on a much larger scale. In 1944, at Bretton Woods, the world established a new system anchored by the US dollar, backed by gold. This was supposed to prevent the beggar-thy-neighbor currency wars of the 30s. However, by 1971, the debt required to maintain the American empire outpaced the gold in its vaults, leading Nixon to sever the link. Since then, we have lived in a world of pure fiat, a system where money is not a store of value but a certificate of debt. For 50 years, the system worked because the US could export its inflation and the rest of the world was willing to hold its debt. But the mechanism is reaching its terminal limit. Total global debt now exceeds $300 trillion, representing over 340% of the entire planet's GDP. This is a ratio that makes the leverage of 1929 look modest. We have reached the point where the interest on the debt can only be paid by issuing more debt, creating a geometric acceleration that eventually requires the destruction of the currency's purchasing power to survive. The mechanism behind this is the Eurodollar system, a vast, unregulated web of dollar-denominated shadow banking that operates outside the direct control of the Federal Reserve. This is the invisible plumbing of the global economy, and just like the call loan market of the 1920s, it is currently seizing up. When the Fed raises interest rates to fight inflation, they aren't just slowing down the domestic economy, they are effectively turning off the oxygen to the rest of the world. In the 1920s, the withdrawal of American capital from Europe triggered a domino effect of bank failures, starting with a Kreditanstalt in Austria. Today, we see the same strain in the offshore dollar markets, as nations from Asia to South America struggle to find the liquidity necessary to service their debts. This creates a dollar squeeze, where everyone is forced to sell assets, stocks, real estate, gold, just to get their hands on the currency required to stay solvent. This is the mechanical trigger of a deflationary crash, a forced liquidation where the value of everything drops simultaneously because the medium of exchange itself has become too expensive. The parallels to our modern era become even more chilling when we examine the geopolitical shift. The 1920s were marked by the decline of the British Empire and the rise of a multipolar world that refused to cooperate. Today, we are witnessing the fracturing of the Pax Americana. For the first time since the end of the Cold War, major powers are actively seeking alternatives to the dollar-based trade system. The rise of the BRICS nations, the weaponization of central bank reserves, and the return of gold as a primary reserve asset among Eastern central banks are all signals that the global trust which holds a fiat system together is evaporating. In 1929, the lack of a lender of last resort that the world trusted allowed a localized market crash to become a global decade-long depression. Today, the IMF and the World Bank find themselves increasingly sidelined as the world divides into competing economic blocs. We are seeing the return of economic nationalism, where nations prioritize their own survival over the stability of the global system, unaware that in a hyper-connected world, no one survives the collapse of the network. This acceleration phase is fueled by a phenomenon that historians call the illusion of wealth, a period where the nominal value of assets continues to climb even as the structural integrity of the economy dissolves. In the late 1920s, this was driven by the advent of installment buying and margin trading, which allowed the average citizen to gamble with money they didn't have. Today, this has been replaced by a much more sophisticated and dangerous engine, the 2 quadrillion derivatives market. These are financial contracts built upon other financial contracts, creating a tower of leverage so tall that no one can truly see the top. When the 1929 pattern returns, it manifests as a sudden loss of faith in these counterparty agreements. Just as the interconnected debts of 1929 collapsed when the first link broke, our modern financial system is a series of just-in-time liquidity promises. If one major institution fails to meet a margin call, the resulting chain reaction could liquidate decades of global savings in a matter of days. We must look at the wealth concentration metric to see the final piece of the 1929 puzzle. In 1928, the top 0.1% of Americans held roughly the same share of national wealth as they do today. This is not merely a social issue, it is a critical economic malfunction. When wealth is concentrated to such an extreme degree, the velocity of money, the speed at which currency moves through the economy, collapses. The elite cannot consume enough to keep the engine running, and the working class no longer has the purchasing power to sustain industrial production. In the 1930s, this led to underconsumption, where warehouses were full of goods that no one could afford to buy. Today, we see this reflected in the stagnant real wages of the West and the massive overcapacity in the East. The system is producing more than the global population can pay for without further debt, but the debt capacity is at its absolute limit. The big truth that the 1929 pattern reveals is that there is no such thing as a permanent plateau. Central banks have spent the last 15 years trying to abolish the business cycle through massive liquidity injections, effectively banning the market from correcting itself. But in doing so, they have not eliminated risk, they have only stored it. By preventing a series of small, healthy fires, they have allowed the underbrush of debt and malinvestment to grow so thick that the inevitable fire will now consume the entire forest. This is the Minsky moment, a point where the system can no longer be sustained by speculative bubbles, and instead enters a phase of Ponzi finance, where assets are sold just to pay the interest on existing loans. As we look toward the climax of this cycle, we see the emergence of the great volatility. In the final years before the 1929 crash, the market didn't just go up, it swung wildly. These were the death rattles of a dying monetary regime. We are seeing these same swings today in the bond market, the price of gold, and the erratic behavior of global currencies. These are not signs of a healthy market reacting to news. They are signs of a system that is losing its ability to absorb shocks. The elites understand this. Behind the scenes, we see a massive pivot toward hard assets. Governments are repatriating gold, Billionaires are buying vast tracts of arable land, and sovereign wealth funds are moving out of paper promises and into physical commodities. They are preparing for the moment the 1929 pattern completes its circle, the moment the music stops and everyone realizes there are no chairs left. The climax of the 1929 pattern is not a single day of panic, but the moment the feedback loop of reality overrides the feedback loop of credit. In the 1920s, that moment arrived when the Federal Reserve, realizing the monster it had created, attempted a late-stage tightening of the money supply. They hoped to prick the bubble gently. Instead, they shattered the glass house. Today, central banks are in an even tighter corner. If they lower rates to save the banks, inflation devours the currency. If they raise them to save the currency, the debt mountain collapses. This is the terminal choice. In every historical collapse of a debt-based empire, from the late-stage Roman debasement to the Weimar hyperinflation, there comes a point where the governing elite must choose between the survival of the financial system or the survival of the social contract. The revelation we must confront is that the 1929 pattern is not a failure of the system, but a fundamental feature of it. Modern finance is designed to expand until it reaches the limits of physical reality, at which point it resets through a violent transfer of wealth. This transfer does not destroy wealth, it merely relocates it. In the 1930s, wealth moved from the over-leveraged middle class and the speculative banks into the hands of those who held hard claims: gold, land, and the means of production. Today, we are seeing the modern version of this migration. As the paper markets become increasingly volatile, we observe a quiet exit by the most informed players. They are moving into non-counterparty assets, assets that do not rely on someone else who has promised to pay. This is why the price of gold has reached all-time highs even in the face of high interest rates. A historical anomaly that suggests the world's largest holders of capital no longer trust the ledger. As the narrative reaches its conclusion, we must reflect on the warnings of economic historians like Charles Kindleberger and Nikolai Kondratiev. They argue that these cycles are human. We are driven by the same fear, the same greed, and the same short-term memory that plagued the investors of the 1920s. We believed we were different because we had computers, yet we used those computers to build the same house of cards, only faster and more complex. The 1929 pattern has returned because we have once again reached the end of a long-term debt cycle, and the math of the system has finally run out of variables to manipulate. The final truth of 1929 was that the crash was only the beginning. The real story was the decade of restructuring that followed. It was a period of pain, but also a fundamental change that laid the groundwork for the next 50 years of growth. We are entering that period of restructuring now. The shifts we see in the headlines, the wars, the bank failures, the digital currency debates, are not isolated events. They are the friction points of a world being forced back into alignment with economic reality. The pattern is complete. The question that remains is not whether the system will change, but who will be left standing when the new foundation is poured. History is not a straight line. It is a circle, and we have just come back to the start.